Financial markets did not have a good week with the sudden and unexpected reemergence of the growth scare. We had oil prices, real commodities, oil back down below $70 per barrel, futures curve flattening quite a bit, gasoline prices weak. We had the 2 year US Treasury, which is down roughly 40 basis points from its high in the middle of January. And very briefly, it fell below 4% for the first time since the middle of October. We've had other markets like stocks. Nvidia's earnings failed to inspire or failed to quell substantial worries about the AI bubble cracking. We've got Bitcoin, which seemed invulnerable for a long period of time, suddenly crashing by more than 25%. It was not a good week for the financial markets because more and more it seems, and these are all signs of the same thing, markets are beginning to really digest here whether or not this growth scare is more than just a scare. And as we've been talking about this for however long, the growth scare didn't actually reemerge. It's not what's really happening here. It never really went away. Instead, what the financial markets are doing is coming to grips with the fact that everything that they ignored over the past couple months is still there, and in fact is actually getting worse. And in many ways, they're being forced to deal with economic reality that is no longer so easy to dismiss and just say, well, Jay Powell's right, soft landing, strong and resilient. So whatever direction you want to look in, you've got the dollar that's spiking, you've got treasury yields and bond yields that are going lower, you've got commodity prices that are struggling, even the stock market is in on this. So Steve Van Metre, not a good week for financial markets. The growth scare is back on the menu, and I think this time it's being taken seriously in places where before it was just completely ignored and dismissed.
Yeah, Jeff, I love that you mentioned how, the growth scare was kind of just covered up. And in reality, we've been talking about how the economy was slowing. And a lot of the experts, they see it too, but they had a lot of reasons why things were going to change. Well, the Fed cuts rates, so that's going to make a difference. And of course, as we know, it didn't. And then it was, well, the election, that's going to change everything. Consumers are just pent up, ready to spend as soon as we get a new president. And well, while the consumers did come out and spend, it was due to tariffs, not because we have a new president. And what do we see then in the factory sector? New order demand slow down. And now what are we hearing? Well, there's just a little bit of a slowdown. We start the first of the year, but don't worry, consumers they're going to come out and spend big. And there's just all this denial that the economy has been slowing down. But you're right. We're finally starting to get signs. People are starting to wake up. And I think a lot of it has to do with the equity markets coming down, particularly crypto, because it's something a lot of people say, look, this is not going to go down. And if it does, don't worry. But what we're starting to see signs of liquidity issues. We're really starting to see the media pick up on the fact, hey, you know what? Maybe the economy is slowing. Maybe the labor market isn't that strong. Maybe all these Doge cuts are going to have a negative impact. So yes, you're right. It's been covered up, but now the growth concerns, well, they're back on the front page.
Yeah, it's funny. We were talking about this a little bit earlier. Even something like GDPNow, which is the forecast from the Atlanta Federal Reserve about what GDP will be in the upcoming quarter, at least during the quarter that we're in now. And the GDPNow, after the data just came out this week, suddenly plunged down to 1.5%, minus 1.5%. And all the people who always say, well, look at GDPNow, look at GDP, it's strong and resilient. Suddenly they're saying, oh, the GDPNow is negative. Pay no attention to that. It's filled with a bunch of one-off factors when, as you just said, we've been talking about this all the time. The one-off factors were the positive ones in the fourth quarter, especially all the people that were beating tariffs, the sentiment that was sky high because the Fed cut rates and the election and a whole bunch of other things. It was, you looked at, especially the stock market reaction to everything. It was, you look at the fundamentals of the economy and they were supported. They seemed to be supported by all those one-off factors, which meant that at some point when the one-offs and all the front loading ended, somebody was going to yank the rug out from the economy. At least that's what it was going to feel like. It was going to feel like that once the give back and the payback period started, it would feel like, oh, what happened? We were strong and resilient one day, and then suddenly the next day it's, oh, everything seems to be going in the wrong direction. Everything's going wrong. So I think that's what really has gotten some of the financial markets really grabbed their attention, is that it's starting to feel, you can feel the rug starting to be pulled. And so it's not just a growth scare. It's like, holy crap. Everything that we tried to dismiss and ignore as just, this is legitimate strength, all the consumer spending at the end of last year, suddenly starts to feel like, oh, what if it was artificial? What if that is the rug being yanked out from the economy? What do we do now? Let's sell everything. Let's get out of Bitcoin, get out of Nvidia, get out of the AI stocks because there's an AI bubble. It was almost, it wasn't quite panic selling because it wasn't that far. I don't want to make too big of a deal out of it, but it was, I need to start thinking about lightening the load, risk off. I think that's what it was. This week was the first real risk off week that we've seen in quite some time.
Yeah, Jeff, and it wasn't just risk off. It was risk off with the thought of where aren't people or why aren't people coming and buying the dip like we usually see in the past? We see this big flood of buying, whether it's in the equity markets or in crypto. But you're right, kind of the last half of last year was all about hope. In fact, there was so much hope that rate cuts were going to work. You look at manufacturers, they kept their staffing levels elevated because there was hope that people were going to come in, even though they admitted that demand was weakening. There was hope at the consumer level that perhaps prices were going to come down. They were going to get higher wage increases. They're going to get more hours, and somehow they were going to be able to absorb this massive amount of debt they've taken off. But we look at all around the world, and it was all hope in the fact that we know the global economy was slowing down, and the U.S. wasn't an island, and now it's starting to show up in what we see as reality. Equity markets coming down, crypto coming down, AI bubble starting to burst, because despite the fact that these companies have pumped hundreds of billions of dollars into AI, I don't think anyone's actually making a profit on it, Jeff. I see no evidence that it's changing the world. In fact, I know lots of people say, I don't even use it. Now, I know you and I use these tools and other people do. It's a great, support tool. But in terms of this mass adoption, well, if it was massively adopted, it would put a lot of people out of work. And since it's just a productivity enhancement, but nevertheless, we look around at everything that we were hoping was going to happen. Well, the economic fundamentals, as you said, proved otherwise.
That's always the danger, right? With these disruptive technologies, everybody rushes into them seeing the future value. And there is future value here, let's be honest. But it takes a long time to get there. And so I think the importance of the AI bubble and the Nvidia earnings, which failed to quell all of these growing fears, is that we are well away from that period where AI becomes entrenched and therefore profitable and truly productive. And so you add that to all the other fundamental negatives that are starting to reemerge, at least in the mainstream consciousness. And it's like, before you could at least hang your hat on something positive. Like you said, rate cuts were okay, rate cuts. The Fed just did a 50 in September. They followed it up. So maybe that will spark something somewhere. Nvidia and the AI bubble still going strong. And so there's going to be a continued build out in data centers and trade and, exports and global commerce is going to really boom. So you could look at these things and say, okay, I see some of the dark stuff. I see some things slowing down, but there's these really big positives that I can at least, base my whatever it is I want to do, whether it be investing or in the real economy. I can hang my hat on these things and be reasonably assured that I don't have to pay too much attention to the downside. But then you lose the AI bubble. You see that the rate cuts aren't helping, and a whole bunch of these other negatives. Like again, oil prices. What did we see a couple of weeks ago? Chevron said we're going to fire a fifth of our workers, and that's in the oil industry, which everybody I think thinks has been booming. And so it's just one after another, where all of these things combine. And it's like, okay, what used to be lots of bright spots that we could look at and say, oh, there's positives over here. Suddenly they're going dark, and it's leaving everybody to really reassess whether or not they can feel that rug being yanked out from under us.
But Jeff, the bright spot was supposed to be the U.S. consumer, right? Because we look around the world and what do we see? Well, things in Asia, they're slowing down. We know demand's weak. We see the same thing in Europe and UK and everywhere. But U.S. consumers, they were the bright spot. They were supposed to drive massive amounts of consumption, particularly in the services sector that was supposed to flow into the manufacturing sector, and it was all going to turn around. But what happened? We got the University of Michigan sentiment survey. Then we got the Conference Board survey. And what happened? They said confidence was plunging, that despite the fact that after the elections, everyone was euphoric. They thought, okay, this is it. Now things are going to start to really benefit the average American. It didn't. Confidence plunge. And Jeff, we know what that means. It's not about the fact that prices are high or we're in an AI bubble or crypto may be down right now. It's about the labor market. And what we're seeing from consumers in these reports, they're saying, look, I'm concerned about my job. And even worse, not only am I concerned about my job, but if I lost it, I don't think I can get another one. And there's a really interesting thing that happens when people start to believe that they're going to lose their job and they can't get another one. Jeff, they cut their spending.
Yeah, and that's exactly what the data said for month of January at the very least. First of all, we got retail sales. Retail sales were highly negative in the month of January. And then the Bureau of Economic Analysis just this past week, in fact, just on Friday, came out with its personal spending and income statistics, and personal spending was down big too. And of course, you'll see a lot of excuses that's, like retail sales, that's just one off. It's the weather, right, Steve? Everybody keeps saying, oh, cold, very cold in January, as if it's never cold in January. But I think to me, the most important part of that was, as you're saying, it's exactly consistent with everything you're saying, but also the income data. The income numbers, what we've seen in the pandemic era is that January, you get a lot of front loaded income growth because you have the cost of living adjustments from the federal government in terms of Social Security. Plus, you have a lot of minimum wage increases that go into effect at the beginning of every year. And some private companies have gotten in the habit of giving out wages at the start of the year, some of it related to cost of living and other factors. So you see this big jump in income in the month of January. But January 2025, while we did see another bump in income, and a lot of it was due to Social Security, it was nowhere near what it was last year and not even close to what it was the year before. So even the January effect on income is slowing down, which I believe was a big part of why January spending was so bad, because consumers, given everything we talked about, like you said, consumer confidence is a reflection of the labor market. Consumers can tell, they can feel the rug being yanked out too. So it's almost like they had one last hurrah. Last year, they bought a bunch of stuff, especially cars and automobiles. Why? Not some of it lower interest rates, sure, but it was, let's beat the tariffs. So let's beat the tariffs and buy stuff before the prices go up. So everybody front loaded a ton of demand into late last year, which wasn't all that great to begin with. And then the payback began in January. And it looks like, given the consumer confidence numbers and a lot of the sentiment indicators in February, it wasn't just cold weather in January. It's continuing on into February. So again, we keep coming back to this. The growth scare is now being taken seriously in financial markets because you can feel it coming from all these different directions.
Yeah, Jeff, and you can see this rug pull effect happening. And the consumers are starting to feel it because there was something in the data today that really kind of made things clear. Because when you talk about sentiment surveys, people can say that I'm optimistic or I'm pessimistic, but in the end of the day, it's what do they actually do? Now we could say, all right, well, spending declined. But as you made the case, well, it's because incomes didn't grow as much as they have in prior years at this time. But there was one thing that did give us a strong indicator that consumers are worried, and its personal savings rate. That started to go up. And we already know that if a household is worried about their income going down or job losses, there's two things you're going to do, Jeff. One is you're going to start to increase your savings, and the other is you're going to start to pay down your debt. And where are you going to do that with? You're going to cut your spending. Of course, that's already made worse the fact that a large part of the country saw really cold weather. So on top of all of this, utility bills are going up, just like we saw in Germany. Utility bills going up, and all of a sudden say, hey, that looks good in the headline data. It says, hey, demand is there, but it means demand on the discretionary side has to go down because incomes aren't keeping pace. So all of a sudden now, when we see this personal savings rate go up, to me, Jeff, that is a huge red flag. People aren't just paying lip service and saying, hey, I think things are bad. They're starting to act like things are getting bad.
Yeah, that's another factor. We talked about this a couple of weeks ago or last week. Utility output was huge. It was like 7.2% in the Fed's industrial production numbers, which made industrial production look relatively decent. Except when you realize, okay, utility output up 7.2%. Somebody's going to have to pay for that. We're talking about usually, small businesses, big business, but really consumers. And so that is a fact. That is absolutely a factor in the weakness in spending in January, because everybody knew, oh boy, it's getting really cold. My heating bill next month is going to be enormous. Maybe I better cut back this month because it's not going to be, it's really going to be an imposition next month. So again, I think that's the theme here that the markets were really getting at, is that it's coming from every different direction. Utility bills were high. Auto insurance bills, we've been talking about that for a long time. Auto insurance bills, they came in sky high. Auto insurance rates are going to go up. You got questions in the labor market. You got all of this artificial stuff from last year that didn't pan out. Rate cuts. Well, boy, they don't seem to be helping here. And so it's like one after another of all these things that were supposed to be supporting the economy have suddenly disappeared just recently, to the point that the invulnerable stock market, or mainly invulnerable stock market, starts to say, okay, maybe something's going on here. But more importantly, the real markets, the financial markets, interest rates, the 2-year treasury's back down to 4% again. So even though Jay Powell and the FOMC continue to talk about, hey, it's inflation, 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 we're not sure about inflation, it's more inflation. The marketplace is saying, yeah, you say inflation today, but like last summer, pretty soon you're going to realize the economic weakness that's coming from all these different directions. The rug pull is being yanked out from everybody else. You're going to continue to say inflation up until the last second. And then all of a sudden you're going to be doing, oh, maybe we need to cut by 50 again.
Jess, I'm glad you mentioned that because if we're talking about the rug pull for the consumers, but the big rug pull isn't Americans because a lot of them knew it. They've been told like, hey, you're strong and robust and your financial picture is great. They heard that from the Fed. They heard that from the manufacturing sector. They're hearing that from everybody. And most of them are saying, look, I don't know who you're talking to, but I'm drowning in inflation. My debt is going up. This is not a good situation. We know they're going to do it. They've done it every time, but that's going to be the biggest rug pull of all because they said it wasn't going to happen.
Yeah, it's the financial markets that are picking up on all of these signals, and as you said before, we can see it come. We could see it coming from various places around the rest of the world outside the United States. There's been incredible amounts of weakness there and deterioration in places where everyone keeps saying, okay, Europe, for example, they're going to turn it around this month or this quarter. This is going to be the time. And instead, everything in Europe has been pointing at substantial deterioration, and things are getting worse there. So it's a globally synchronized synchronization of the rug pull that's coming from every single direction. It doesn't matter where you want to look. Oil prices, gasoline prices, real commodities, financial markets, interest rates, stocks, equities, crypto. Did I leave anything out? The dollar, the exchange value continues to go higher. That's another big signal that things are not going in the right direction. I think the only thing that's reemerged here, right, Steve, is the fact that people are now paying attention to all of these things, whereas before they were more easy to just set aside and say, okay, that's just a bunch of noise.
Jeff, I think you summed it up perfectly. All of a sudden, the financial markets, businesses, the economy is waking up to what the consumer has been telling them for months, is that things aren't good and they're about to get much worse.